Hi, this is Matthew Cratter from Trader University. And today I want to talk about what just happened this week to momentum stocks. I've been getting a lot of emails about the reversals we've been seeing in a lot of the names we've been following. So if you're interested in momentum stocks, trading momentum stocks, or seeing what I'm doing with my portfolio, make sure you hit that subscribe button because this is one of the things I do cover a lot in my channel. So this was a very quiet week on the surface. If you just look at the S&P 500, we actually hit all-time new highs on the index, though we weren't able to close up there. Same for the Nasdaq. So a very quiet week on the surface. But if you look below the surface, there were some very, very violent moves, and many of them in some of our favorite momentum names like Roku, Shopify. You can see these pullbacks here. A lot of pullbacks below the 50-day moving average, which is the initial warning sign. In this market environment, I will take profits or take my stop loss on a daily close below the 50-day moving average. I'll be more aggressive in different kinds of markets, but in this one, which is behaving a little funny, I tend to be a little more conservative that way. So I'll wait for the stock to close, and if it closes below the 50-day moving average, then I'll exit. And a lot of you have been asking me that question. Just two more names, Twilio, which is not only, you can see here is a great example of why you always want to exit, especially in this environment, on a close below the 50-day moving average. Once we got that in Twilio, you can see much more damage was done, and now we got to close below the 200-day moving average. So again, very important to adhere to stop losses in this environment. Here's a chart of Okta, OKTA, looking very similar. So at the same time that momentum stocks have been breaking down, we've had some other interesting trends. We've had a big flow into value stocks, SPYV, it would be the ticker for this, hitting basically new 52-week highs here. We've had a huge pullback in gold, GLD, silver, SLV, and a lot of the gold stocks we like Kirkland Gold as well. And the really big move, the big fundamental move, has been in TLT, in the interest rates on the long-dated Treasury. So the 20-year Treasury, the 30-year Treasury, you can see a huge pullback here, and the yields have spiked in the process. And as part of that, a lot of sort of defensive names like REITs. Here's Public Storage, PSA. These tend to trade just like sort of long-dated bonds. So when interest rates spike as they have this week, these will tend to sell off. Now, so what's happening here? Well, I would contend that there are two basic things happening. The first thing is that there's been a big pullback in tech valuations, and as a result in these momentum names, as a result of people kind of looking at the WeWork potential IPO and seeing what a joke it is. And a lot of tech investors have begun to rush for the exits. Now, the easiest place to rush for the exits is in the public markets. So if you own some Uber and you see the lockup the lockup expiration is approaching, or Lyft, or what's another one? Slack, WORK. You can see that tech investors are taking profits where they can here. And as a result, stocks like Twilio, Shopify, Okta, all these ones we've been talking about. This is, I would call it, the big WeWork revaluation. So these names have suddenly become much more volatile and much more dangerous. So I think that's the first thing going on. And that's one of the main things driving momentum stocks. The other is, I would say that there's been a trade. You have to excuse my voice today. I'm suffering from just getting over a cold. There are things called long-short equity funds. And what they'll do is maybe they'll go long momentum stocks and they'll short retail stocks. And so, for example, if you think we're going into recession and you think enterprise software companies are still going to do well because they're very high growth companies, but you think the consumer is going to have a lot of trouble, what you might do is you might go long a name like Twilio or Okta. You'd go long that, and then you would short a basket of retail names against it. So a good example of that would be XRT, which is the S&P 500 retail index. Now what's happened is there's been an unwind in these long-short trades. And it's playing out very, very technically. So you can see we've had just a huge spike in XRT, which is, a lot of troubled retailers, some not so troubled, but huge short covering here as people, they're long momentum, long Momo, short retail. And so what happens when this sort of trade unwinds is that momentum goes down, even though it's been going up, and retail goes up, even though it's been going down. And there are a couple other places that's happening, and it seems to be in sort of economic sensitive areas of the economy. So if you look at the cruise lines, for example, so people take cruises when the economy is good. When the economy is not good, they obviously you don't need a cruise. It's a discretionary expense. So if you look at RCL, has a big spike over the last week, and CCL would be the other one, Carnival Cruises. It's gone from 42 to 50, just an enormous percentage move, especially for a stock like this. And at the same time, you've had a big recovery in a lot of the financials. Bank of America, BAC, WFC, Goldman Sachs. These have rallied. So I think another trade that is unwinding is long momentum, short financials. That's unwinding. And at the same time, there's been, I would say, sort of the third trade that seems to be unwinding is kind of long, high quality growth momentum stocks of the kind we've talked about. The Roku, Shopify, Twilio, Planet Fitness, all these names. And then short, hated names of companies that probably deserve to be hated. They're losing money, and they may go out of business just because of their business model. So, for example, GameStop would be a great example of that. GME had a big spike over the last week. It's now a penny stock, but you can see it's moved from the sort of mid threes, and it went even above 5 today. Enormous percentage move. GoGo is another one. These are highly shorted stocks. GoGo's moved from 4 to 6, very high percentage move. Fizz, National Beverage Corp. And then one that I've been long, ASPS. This was sort of the recession hedge. They do help companies with foreclosures and short sales if the economy turns south. ASPS, you can see that's been a shorted name. It's been holding up very well, and it's been a good hedge in my portfolio. And then finally, I would say Tesla. A lot of you have been asking about Tesla. Tesla, highly shorted name. In a recession, will not survive a recession. And so I would say this basket of hated, shorted names has been rallying. And it's for very technical reasons. So there are two ways of looking at this. First, there's the WeWork IPO, which will resolve itself one way or another. But until that does, these tech momentum names, these enterprise software stocks, are going to be more volatile, and we'll have to monitor whether people continue to rush for the exits. So these are definitely names that you want to keep a close stop. I would say some of the momentum names, not necessarily tech names, that have been holding well. Lulu's been holding very well, as has, let's see here. Well, that's the one that really jumps out at me. CPRT, which we talked about last week, that one's holding quite well as well. And then ASPS, which is kind of our hedge, is holding well. So the really important thing is to pay close attention to those 50-day moving averages. Make sure you know where your stops are, and understand that sometimes these weird technical movements can happen. And there's been huge hedge fund losses the last week as a result of this, as a result of these sudden reversals. Now, one way to play it is to sort of fade it. So if you were fading this, for example, you would increase your short on hated names like Tesla, for example, or GameStop, some of these companies with pretty questionable business models that are losing money. And then you could re-enter some of the momentum stocks, especially as they get close to, you can see Shopify here. You can play a bounce at the 50-day moving average. You have to be very careful. I would say Shopify here looks more like it's breaking down than breaking up. So definitely it's a volatile environment, one to keep a close eye on your stocks and your stop losses. And I would say this is actually a difficult environment for making money. So not a bad time to buckle down, maybe take some courses, and study up on the stock market, and let some of this volatility pass. It would appear that the market is now not pricing in a recession. We've had a huge spike in yields, and you can see Treasury yields over the last month. The yield curve has steepened quite a bit, which is a bullish sign for the economy. You can see that the back end rates have moved up. So the 10-year and 30-year rate yields have moved up much more than they have at the front. So we call this, if we had before an inverted yield curve, what we're seeing now is more of a flat to steepening yield curve at the end. And so one has to decide, is the market wrong here? Have we narrowly averted or avoided a recession because of the Fed cutting rates fairly aggressively this summer and going into the end of the year? Or is this one of those technical movements where there were some crowded trades, gold, momentum stocks, some of these things, which we were guilty of. We were playing as well. And is this just a simple unwind in that, or is the market pricing in a chance that we've avoided a recession? And that would explain why things like retail and the cruise lines are doing so well. So just some thoughts. You can see that I'm still sort of trying to solve this puzzle in my own mind. If you enjoyed this video, make sure you hit that subscribe button and let me know your thoughts in the comments below. I'd be really interested in what everyone else thinks of this market. It's definitely been a very weird week, and it's actually fairly reminiscent of what they call the quant quake of 2007, which I remember well. And there are even articles, Financial Times, comparing what just happened to the quant quake, which was another sort of technical unwinding among quant fund strategies. And the quant quake was interesting because it happened in, I believe it was late summer, August of 2007. And many now see it as sort of a canary in the coal mine about the great financial crisis. There were weird things happening under the surface in the market. And this was an early warning sign of a bear market. So that may be another alternative to what we're seeing now. Anyway, let me know your thoughts, and I'll see you in the next video.